SPYD is often described as a simple way to earn high dividend income from the S&P 500. But dividend yield is not a measure of stability, and it's not a measure of quality. SPYD selects stocks based on yield alone, weights them equally, and rebalances mechanically, without evaluating balance sheets, payout durability, or financial stress. That structure determines not just how income behaves over time, but how the fund responds during drawdowns, rate shifts, and economic stress. SPYD is State Street's S&P 500 High Dividend ETF. It's a passive ETF designed to provide current income by tracking a high dividend subset of the S&P 500. SPYD is not designed to maximize growth, valuation efficiency, or total return. Its mandate is narrow and explicit: systematic exposure to dividend yield within the S&P 500. Structurally, the investment universe is limited to S&P 500 constituents. Selection is based solely on dividend yield, and holdings are equally weighted and rebalanced on a fixed schedule. SPYD doesn't evaluate dividend growth, balance sheet quality, or payout sustainability. Every outcome the fund produces flows from that single design choice. SPYD begins with the full S&P 500. From that universe, the selection process is fully rules-based. All constituents are ranked by dividend yield. The 80 highest yielding stocks are selected, and each holding is assigned an equal portfolio weight. SPYD does not weight or filter holdings based on market capitalization, earnings growth or profitability, or balance sheet strength or leverage. As a result, SPYD systematically allocates more capital to smaller companies within the S&P 500 and stocks whose yields are elevated due to recent price declines. Dividend yield is calculated as annual dividend divided by current share price. That means yield can rise for two very different reasons: the company increases its dividend, or the share price declines. SPYD doesn't distinguish between these two outcomes. As a result, companies with falling prices can move higher in the yield rankings, even when the underlying business is deteriorating. This creates systematic exposure to value-oriented characteristics and elevated financial stress during certain market regimes. SPYD doesn't screen for payout sustainability or balance sheet strength or refinancing risk. That design choice explains why SPYD's risk profile can diverge sharply from dividend strategies focused on stability or growth rather than headline yield. Equal weighting assigns the same portfolio weight to every holding, regardless of company size, profitability, or balance sheet strength. On the benefit side, equal weighting limits concentration in the largest companies and spreads exposure evenly across the selected high yield group. On the cost side, equal weighting requires higher turnover at each rebalance, increases exposure to weaker balance sheets, and reduces defensive characteristics during periods of stress. High yield stocks with weaker balance sheets or cyclical exposure tend to decline faster during market stress. As a result, drawdowns have historically been deeper, and recoveries have historically taken longer. These outcomes are not discretionary, they're direct consequences of equal weighting interacting with high yield selection. Dividend yield is unevenly distributed across the equity market. Because SPYD selects stocks strictly by yield, sector exposure is an output of the rules, not an allocation choice. Historically, this has produced persistent concentration in high yield sectors. These tilts are not tactical, they're not adjusted for valuation, economic outlook, or market momentum. Because of this structure, sector exposure can remain concentrated for long periods, and portfolio performance becomes highly sensitive to sector-specific conditions. SPYD doesn't behave like a broad market index fund. It behaves like a rules-based income portfolio with embedded sector bias, driven entirely by dividend yield differentials rather than discretionary allocation decisions. The performance of SPYD is not random. First, interest rates. Because SPYD emphasizes high dividend yield, its cash flows are sensitive to changes in discount rates. When rates are stable or declining, income-oriented equity exposure becomes relatively more attractive. When rates rise quickly, higher yield equities tend to face valuation pressure. Second, the relative performance of value versus growth. SPYD's selection process tilts the portfolio towards value characteristics by construction. When value stocks outperform growth, SPYD tends to benefit. When growth leadership dominates, SPYD typically lags broader market indices. Third, dividend stability. SPYD does not screen for payout sustainability. When dividends remain intact across its holdings, income is maintained and drawdowns are contained. When dividend reductions increase, particularly in cyclical or leveraged sectors, performance deteriorates. These patterns are regime dependent. They arise from SPYD's structure and selection rules, not from forecasting, discretion, or active management. SPYD is built around a single explicit trade-off. It prioritizes dividend yield over balance sheet resilience. That outcome follows directly from its structure. Stocks are ranked solely by dividend yield. The highest yielding names are selected regardless of cause, and all holdings are equally weighted. Dividend yield can be elevated for different reasons. It may reflect strong cash generation, and it may also reflect a declining share price driven by deteriorating fundamentals. When conditions deteriorate, dividend reductions become more frequent, and equal weighting prevents capital from shifting towards more resilient firms. Understanding this trade-off is essential because it defines both the upside and downside of the strategy. SPYD typically displays a higher headline dividend yield than the broader equity market. That yield, however, is not stable. When companies reduce or suspend dividends, those changes flow directly through to the investors. SPYD doesn't actively manage income variability. It doesn't offset dividend reductions within the portfolio, and it doesn't target a stable payout level across market cycles. As a result, investors should expect cash distributions to fluctuate, income to decline during recessions or sector-specific downturns, and yield levels to change as market conditions evolve. The fund emphasizes current dividend yield, not dividend consistency or dividend growth. For investors, this distinction matters more than the stated yield, because it determines how income behaves when conditions change. SPYD's distributions are taxed based on their underlying composition. Whether dividends qualify for preferred tax treatment depends on the holding period of the ETF, the characteristics of the underlying companies, and the investor's individual tax situation. SPYD doesn't manage distributions with tax efficiency as a primary objective. Because the fund reconstitutes regularly based on dividend yield rankings and experiences higher turnover than capitalization weighted index ETFs, its tax efficiency can be lower than that of broad market funds with minimal trading. As with income stability, tax outcomes are a structural consequence of the strategy, not an adjustable feature of the fund. SPYD is designed for investors with a specific objective: current income, not broad market exposure. It may be appropriate for investors who prioritize cash income over long-term capital appreciation, understand and accept sector concentration as a structural feature, and can tolerate higher volatility than dividend growth or quality-focused strategies. SPYD is not designed to maximize long-term equity growth, provide downside protection during economic contractions, or deliver stable or consistently growing dividend income. In most portfolios, the size of the allocation has a greater impact on outcomes than the decision to include SPY at all. This is an income tool with defined trade-offs, not a substitute for broad equity exposure. SPYD functions best as a satellite income allocation, not as a core equity holding. Its concentrated yield exposure and persistent sector tilts make it unsuitable as a standalone representation of the equity market. In practice, SPYD is most often used to layer income alongside growth-oriented equity exposure, introduce value-sensitive yield during favourable market regimes. SPYD's impact should be evaluated at the portfolio level, not in isolation. How its income interacts with other holdings, how its volatility affects overall drawdowns, and how its sector exposure overlaps with existing positions. Used incorrectly, it amplifies concentration. The difference is allocation context, not the fund itself. SPYD is a rules-based high dividend ETF that selects the highest yielding stocks within the S&P 500 and weights them equally. The core trade-offs are mechanical: higher current yield paired with higher volatility, persistent sector concentration as a direct result of yield targeting, methodological simplicity in exchange for limited selectivity. SPYD doesn't adapt to market conditions. It doesn't adjust for economic regimes. Outcomes follow the rule set, not expectations. SPYD works only when it's evaluated and sized within that constraint. Outside that framework, misallocation is the default outcome.